Good afternoon. My name is Brian Makris, and I'm here with Grit Matters. I'm the president and CEO of Home Choice Lending, and today we have an incredible guest. This is something that I've always wanted to learn more and more about. We have Ann Bellamy, and she is a hard money lender. And Ann, thank you for joining us today.
My pleasure, absolutely.
So I want to talk a little bit about it. You know, what is it, and how does it work? And tell me a little bit about hard money. You know,
Okay.
I mean, everybody wants to know, how do I get it? I hear it exists out there, and I don't even know where to go. So tell me a little bit about it.
And it sounds scary too, right?
Right.
Hard money sounds scary and hard.
It makes me think of the old days of, if I don't pay up, someone's coming after my kneecaps.
With a baseball bat.
Correct.
Right.
Correct.
So hard money is actually a mortgage based on a hard asset. That's all it is.
Okay, so like a house.
Like a house, exactly. So the term came strictly from hard asset, and the old mortgages back in, I don't know, before World War I, they were all hard money loans. They were all just based on assets, and I guess you used to get like 50 cents on the dollar as opposed to 97% like we give now.
Right.
But that was all that was available, you know, decades ago. So the term has evolved, and it became kind of scary because people are used to conventional, you know, residential loans, and they're not used to the old-fashioned loans. So then the term hard took on, like hard to get or hard arsed or something like that, you know, like it just sounds awful.
If they said easy money, people would think of it differently.
Right, exactly. But that's all it is a mortgage based on a hard asset, which is real estate,
So first of all, how did you get started? How did you get started in this? And tell me a little bit about your travels to get here, because some of this is your money.
Yes, it is. So I didn't wake up one day and say, Mommy, I want to be a hard money lender. That's not what happened. No. I did have an epiphany and want to become a real estate investor. So I did do that.
Okay.
And then what happened was, as I connected with other real estate investors and started attending real estate investor groups and associations, so I ran for the board of directors of one of those associations, and when you don't have anybody running against you, it's not very difficult.
You won.
I won, yeah.
Wow, nice.
And,
good campaign.
Yeah, great. And so then I found myself standing in front of a room full of people that needed money for their projects. And an opportunity fell into my lap, just happen chance, but life is full of happen chance, right?
Yep.
And it's what you do with it that matters. And so I connected with somebody, and we said, let's go lend out this money. And so we went and got educated and together, and the two of us started lending money just through that Real Estate Investor Association, which was actually the New Hampshire Real Estate Investors Association.
Wow.
So I made tons of mistakes. I screwed up all the time. I lost money. Sometimes my money, sometimes not my money. It's worse when it's someone else's money.
I get that. I believe
if you lose
that.
your own money, you just lick your wounds and move on. You lose someone else's money, oh my God, it's gut-wrenching.
Sure. Keeps you up at night.
It does. It totally does. At least if your priorities are aligned properly. Yeah. So anyway, I evolved. I brokered some money to other investors, and then my business evolved to the point, since I was doing pretty well, my business evolved to the point where I could lend out my own money, and I now have just one partner, so we use my money, his money, and that's it. So I don't have any other investors now.
So you make the rules on whether or not you lend. So the final decision maker is you and your partner at the end of the day?
It is. I do all the underwriting.
Okay.
I also do all the marketing.
Okay.
We're a very small shop.
Okay. So
Are
you pulling credit?
I'm not.
You're not. That's amazing.
It is. In your world, it's amazing, right?
So I lend money, Fannie Mae, Freddie Mac, FHA, VA, conventional style lending, and she doesn't pull credit.
I don't even ask.
Oh my goodness.
I don't even ask. I don't even look for Credit Karma.
Wow.
I don't ask for your income. I don't ask for your, assets, that's a different story a little bit. But no, I don't ask for that. Now, if a borrower has a good credit score and they want to tell me to sort of strengthen their application, that's always good to know.
Gotcha.
But we don't ask. We're looking at the deal. We're looking at the amount of cash that the investor is putting into the deal, and we're looking at experience, because the less experience one has, as with all things in life, the bigger your mistakes and the more they cost.
Absolutely.
And we don't want it to be us that costs. So, I didn't say that right.
No,
But you got what I was saying,
yeah,
right?
I know exactly what you're saying. The bottom line, experience is everything. So
Experience is worth a lot.
An investor that's buying a home that's going to flip it has a contingency plan built in for the mold, for a foundation issue, for a roof issue, things that are not quite as visible as they might think.
And actually, that's a line item on the budget, is just contingency.
Reserve. Contingency budget.
Exactly. You don't know what it's going to be, but it's going to be something.
I agree with that. It's always something.
Yeah.
So when do we use it and when do we call Ann?
Okay. So you don't use it when there's a homeowner trying to get a mortgage.
So this is not for me trying to buy my own house.
That's correct.
This is an investor that's going to try to buy a home short term, and they're going to be selling that home to liquidate and pay you back.
Selling or refinancing. So this product is primarily used, it's only by real estate investors, okay? We don't work with homeowners at all.
Okay.
And it's only real estate investors taking title in an entity, okay? That's a requirement also. And they have to have a short-term exit strategy out of our loan, and that normally is fixing it up and selling it, fixing it up, renting it out, and selling it. Or it can be fixing it up, renting it out, and refinancing. And it can also, we also frequently will do, single-family flips.
Okay.
Multifamily flips or multifamily buy and hold for refinance. Condo conversions, where they'll buy a multifamily.
Love it.
Fix it up, turn it into condos, sell those off individually.
Very popular.
Yes. We do new construction loans also. So we fund single-family homes or small developments. But small, we stay under $1 million loan.
Okay.
So,
Okay.
So we're not doing the projects, the $5 to $20 million stuff.
Sure.
We're not. When it's your own money, you feel a little differently about it.
I'm with you. I'm still trying to swallow that part where you don't pull credit.
Yeah, that's right.
No.
No, we don't pull credit. Isn't it amazing?
It is.
So one of the big things that we're looking at when we go to a project, since you brought that up, is if we have to take this back because we have no idea about the integrity of the borrower, if
Sure.
they're new,
Sure.
if we have to take this back, what are we going to do with it? Okay, if it's in New Bedford, Massachusetts, it's a lot harder since we're based in Nashua than if it were in Wakefield, Massachusetts. Wakefield, Massachusetts, easy, we know what to do with it, we're close. New Bedford, Massachusetts is 2 hours just to get there and look at the damage,
Correct. So demographics has a lot to do with your decision
It
making
does.
as well. Because
It
if
does.
you have to, in theory, you're the note owner, so you would foreclose, take the property back,
And then we have to deal with it.
and then you deal with
Right.
it. So
And in the private money, hard money lending space, it is a myth, well, I guess it's not completely a myth, but it is a myth that we do that because we want to take the property back.
Which you
There are
don't.
people that do, but I definitely don't. I am far too lazy for that. If I wanted to do that, I would be doing them myself.
got it. Yeah, all right.
You
all
know?
right. Fair enough. So let's talk about some of the advantages of using this product. I mean, I know speed is probably a lot different. Are you ordering appraisals on this? Are you doing the appraisal yourself? Are you pulling your own comps? How do you, speed, you said you can do one in 2 days. Now, I know you don't like to do it in 2 days, but I'm guessing if you have an investor that you've worked with for the last decade and they're like,
That's
hey,
key.
I'm buying this auction property right now, and you're just like, rubber stamp, I know you, we have a great history. But tell me about some of the advantages. Speed's one of them, I'm guessing.
Speed is a big one. So advantages would be, first of all, speed, and I'll talk a little bit more about that if you want me to, because
Sure.
the 2 days does apply,
Wow.
but not all the time.
Sure, yeah, of course.
So speed, less paperwork. We will fund the things that the banks won't. So that's why the majority of our projects are in disrepair and distress. They might only be in distress because there's nothing wrong with the house, but it's a hoarder house. But the hoarders don't want people coming through their house to
No,
look
they
at it,
don't.
and those people won't walk through and go through what we go through either. So the properties are distressed. The banks won't lend on them. They won't lend on them if they have a failed septic. They won't lend on them if they had a fire. They won't lend on them if somebody started a remodel and didn't finish it. They won't lend on it if somebody stole all the copper. Those are very common in my world. They're just the norm. For somebody to call me with a property that's in good repair, I'm like, why aren't you getting conventional?
Right.
Doesn't make sense to pay twice the interest rate from me when you can go get conventional. Well, I don't have time. If I don't close in a week, I lose the deal. Oh, that's different because I can close that quickly.
Wow.
If I have worked with you
Correct.
multiple times.
You got
Yeah, I
the-
can't
you
do
got the
that for
history.
a new customer because we don't know each other. Yeah.
No, I get it. I mean, that
Yeah.
established relationship is everything. You're writing a check, you want to know you're getting it back.
It's true. And so credibility is important from the borrower having faith in the credibility of the lender and the lender having faith in the credibility of the borrower. So as you get a history together, it makes a huge difference. I will do deals for people that I've done many deals with that I would never do with a beginner, but I will do because I know how this person works and that if he has a problem, he won't make it my problem, he'll just solve the
fix it.
problem.
Yeah, he's a fixer.
So, yeah, credibility is key.
Let's talk about for a second, I work with a ton of real estate agents and they always have that interesting property that doesn't fit into the conventional financing. Now, for a real estate agent out there that's going to listen to this and say, I always wanted to know about hard money, when do they call you for this particular property? When is an agent saying, you know, how is this such a big advantage for an agent? First of all, they can probably sell a home, but do you work with real estate agents that have investors as customers?
I do. Usually what happens is that the real estate agent quickly passes me on to their buyer. Okay? Because I have a lot of questions that they may not know the answers to before I can tell them if I can do the deal. But certainly a real estate agent can call me and say, okay, I have this buyer and I have this property, but I know he can't get conventional and he doesn't have enough money to pay it cash, so how does that work? I assume that's kind of the scenario that happens frequently. And residential conventional or commercial conventional won't do it. So I can ask a few questions, but I'm going to need answers like how much down payment does the buyer have? And the agent may or may not know that. So give me the property address so that at least I make sure it's in the area that we work. Give me the type of property is, like a single family and it's a hoarder house or it's whatever it is, or it's they listed a property that the foundation is crumbling or whatever. And they have a buyer, but they don't know exactly how to counsel their buyer. So usually I can have a short conversation with the agent and then usually they pass me on to the buyer. If the agent wants to be in on the conversation, I'm happy with that. It's perfectly fine. If the buyer, because the buyer is actually my customer, so they may not want to reveal all that confidential financial information to their broker.
Same on this side.
Or maybe they do, whatever they're both comfortable with. And then we'll just move forward with the loan or not, and they'll know right away. We do our underwriting and start our appraisal process, and you asked me about appraisal, and I think I forgot to answer.
That's okay.
We start immediately.
Okay.
So when I'm on the phone with that agent or with the buyer, I'm looking up the property and looking for comps right away. So you're not getting an appraisal the last 2 days before close. You're starting the appraisal at the very, very beginning so that I can tell you right away if we're likely to do this.
Okay.
So speed is partly because we start our appraisal at the beginning. And our average time frame is only 2 to 3 weeks anyway. So if somebody calls me and they have 30 days to close, that's an eternity. That's a luxury for me.
Love it.
That's not like, oh, I have to work fast. That's like,
Right.
oh, well, I'll be
Okay.
back on vacation in a week or so. I'll hook up with you then. Because our attorney, the only thing that's holding up closings right now, and you're probably experiencing the same thing, is there's a backlog of title work.
Sure. Yeah, absolutely.
Title work is the only thing right
Yep.
now that's holding it up.
Yep.
But our attorney has in-house title, so it comes in quicker than most.
I love that.
Yeah.
I love that. Now, what is a typical down payment? If there's a house that's going to be flipped and you've been working with them, what is standard? I mean, I don't even know where a down payment would be. Are you looking for 50% down?
No.
What kind of
That'd
money?
be nice, but
I get it.
I'll do a deal for 50% down almost all the time.
All the time. Got it.
But that's not typical. our down payment requirements range from 10 to 20% of the purchase price, not of the total loan.
Okay.
Okay, because there's always a construction component to our loans, or usually. So a beginner, we require at least 20%
Okay.
Of the purchase price. So that's someone that's never flipped a house or never done a real estate deal. So that's a minimum of 20%, and then as low as 10% of the purchase price. So for example, a $200,000 house that needs a lot of work, the down payment's going to be $20,000, and then maybe their rehab budget is, I don't know, 80. So, but that's not included in the down payment requirement. So we would fund, for example, 80% of the purchase and 100% of the construction budget. And then we have limitations. The total loan can't be more than 70 to 75% of the after repaired value.
And are you also kind of putting together what that after, so if you're saying, okay, this house is worth 200, that's the purchase price, you're gonna have a new loan from you at 180,000, but they're gonna put 100 into it for easy math, and the property's gonna be worth X? Are you doing that as is and as?
Actually, our appraisals are as repaired value. It's not the current value.
So the appraiser's going in with the blinders on saying all this is gonna be fixed, and that's you. You're doing that. Okay. So
that's kind of I'm not an appraiser, I'm not a licensed appraiser, but I don't need to be a licensed appraiser because it's our own money.
I love it.
There's no, there's none of that.
And this is truly incredible. It's absolutely incredible. It is.
But this is what all hard money lenders, well, no, that's not true. That's what all small hard money private lenders do. That's what they all do.
So I've been in the business for 20 years, and you and I were both at the same function. I've spoken at it, and you've spoken at it, and I followed you, but I've just never dug into it, and I regret
as to what it really was.
Probably, if you've missed out on millions of dollars I could have given you over the years.
I'll send you a bill.
Yeah, please. I mean, this is truly incredible. So you're not only going to lend 80%
80% of the
purchase price, but you also can fund the construction to get done, and then they're going to turn around and sell it, 30, 60, 90 days later, cash you out from that point.
Right. And I have a spreadsheet that estimates how much profit they're going to make. And if they're not going to make enough money, we don't do the deal, because who wants to do a deal where they break even or lose money and I make money?
Right.
They're just going to be annoyed with me, and that's going to be the end of that.
Got it. So, and when you look at the profit, I mean, you're seeing these even in today's market with the housing prices the way they are. People are in your group that you're lending to are still profitable. They're making money right now.
It's harder to find but honestly, our business has picked up recently. I don't know if it's just spring is in the air or something like that. It's always quiet around Christmas time in January, but things haven't been that quiet around Christmas time in January. But now all of a sudden, I'm like crazy again.
I love it.
So I guess it's spring, and that's.
I absolutely love it. So how much paperwork is involved in the processing of the application? Let's talk a little bit about that piece, because I know, for us, it's W-2s.
It's like this high of a stack of paper, right?
Exactly. That's conventional lending. So tell me, how is it with you?
So let's say a borrower has a project under contract, and it's going to be a construction project. So they're going to send me the purchase contract. They're going to send me an application, which is a spreadsheet that's downloadable from my website. The spreadsheet is 4 pages. Their personal contact information, the property information, which is pretty brief, along with their executive summary of what they plan to do. Like, I'm going to take this 2-bedroom cottage and make it into a 3-bedroom, 2-bath, 2-car garage house, whatever the summary is. A line item construction budget, which is just a rough idea at this point, that can get fine-tuned. And then the last page is that spreadsheet I talked about that's going to estimate the profit at the end of the deal, so that we all can see about how much they hope to make on the deal, and that we hope that they make on the deal.
Gotcha.
Because that's a component of it. If they're going to lose money, I'm not going to lend them money, because that's a bad deal. Because then we make money, they don't make money, it's a bad deal.
You want win-win.
So the contract, the application, and then then we go and we approve the loan, we go out to the property. That's our quote-unquote appraisal, right? Visit. We go out to the property, and that usually happens within the first week, usually sometimes a couple days. After that, all they have to submit is their W-9 the declaration of commercial use, which is a single-page document, and their insurance certificate. That's my whole paperwork stack.
Wow. Wow, that's amazing.
Now, my closing attorney will have them sign like personal guarantees and all
Sure,
those
of
loan
course.
docs and stuff like that,
Yeah,
but
yeah.
that's it.
So as far as like the builder themselves, if it's somebody like me who's going to buy it, where are they getting their estimates? Do they typically have their contractors lined up? Do you say out of the contractor stuff and you're like, hey, listen, you're going to buy this building, you've got to have all your ducks in a row, and they're coming to you with the estimated cost, and if you look at that estimated cost, are you saying, no, that roof's going to be more like 16,000, not 8,000, and you're making those adjustments to help them if they're a new investor?
Well, we don't get quite to that level of detail.
Okay.
And it depends largely on the experience of the borrower too. So I have a couple of house flippers that can do it cheaper than anybody else.
Love it.
A lot of times it's because they do half the work themselves.
Mm-hmm.
Is that a good business plan? Sometimes it is if you're fast.
Mm-hmm.
If you're slow, it's a terrible business plan.
Right.
The bigger house flip, the guys that are doing a project a week, they're not doing any of the work themselves.
No.
They have plenty
They
of
have a team.
contractors. So I don't look to say that roof is not going to cost 8,000, it's going to cost 16. I'm more looking to say you forgot the roof.
Okay. Yeah, that we need to throw in the line item.
Right. And this house is full of mold and you have nothing for demolition.
Gotcha.
Yeah.
Gotcha.
Yeah, that
Okay.
kind of thing. And my business partner, the one that it's his money and my money,
Mm-hmm.
he also happens to have had a commercial construction company for decades. So we both go out to almost every project and he'll look around and I'll go, I don't think you can do this for 20. What do you think? And he'll go, no.
No.
You need to double your budget.
So then you go to 50, and if the margins are still good, then you're looking at it.
So it also depends on how much rehab they're going to do, because there's all different levels of rehab. I just went out to a project the other day. All she's going to do is paint and replace the kitchen floor.
Love it.
That's it.
That's it.
And she bought it for $300 and she's going to sell it for $400.
Love it. Love it. And she's going to put 25 into it.
Not even. She
Love
does the painting herself.
I love it. I love it. I love
Yeah.
it.
So
So do you sell your loans at the end of the day?
never.
You never.
I've never sold a loan.
So you take it, you service it, and are they paying each month? How does that work? So,
It's interest-only payments,
It's
and
interest only.
they pay each month. There's two reasons for that. One is it keeps it front of mind how much it's costing them to have this loan, which sounds really negative, but speed is key in the house flipping or in even if you're going to refinance. Speed is key because it costs you money to drag your feet.
Absolutely.
So one is it keeps it front of mind that they're spending a lot of money and they need to move their butt. And the other is that when a loan gets in trouble, no one ever remembers how much that interest would have been had it accrued every month.
Mm-hmm.
And they're always shocked at the total loan balance when it's, a year's worth of interest accrued. They didn't plan for it. So there's two reasons for that.
Okay. Now, what about, the rates are definitely higher. Conventional is going to be much lower. That's securitized by Fannie Mae or Freddie Mac or an FHA loan or a VA loan. These are higher. There's obviously higher risk. You're not pulling credit, and you're not really doing a real deep look at this individual.
We're not looking at income even. So
So
they have to have cash.
So
but
I get risk creates, higher risk means higher interest rate. Is that the majority of the reason, or does the interest rate fluctuate like the market for you guys? Like Fannie Mae, Freddie Mac, if you watch their little ticker and the rates are going up or down, how do the rates, do you just wake up today and say, hey, we're lending at this and today it's going to be this? How do you select rates?
they don't change that quickly.
They don't.
It's
It's not a daily ticker.
never.
Okay.
It's more like, the real estate market's still moving upwards and everybody else is now lending at 12 instead of 14. I'm going back a ways
Sure,
now because
sure.
there's not a lot of 14% money out there right now. But it's much slower and it's based on supply and demand
Okay.
and it's regional. What I say and what applies right here in New Hampshire and Massachusetts has nothing to do with Oklahoma, California,
Sure.
Florida, Vancouver, whatever. It's all regional and it's all supply and demand. California hard money rates, I hear, are anywhere from 6 to 8%. 6 to 8% is non-existent here.
Yeah. I'm even shocked because, Fannie Mae and Freddie Mac continue to trend up higher and higher. They're almost the same.
Exactly. And then hard money rates will go up when conventional goes up too.
So when considering a lender, what is so important? What's the important piece when they're going to pick a hard money lender or pick me as a conventional Fannie Mae, Freddie Mac lender? What would you say is kind of that important factor that they must know? I mean, first is speed. We might not be able to do something for 3 weeks or a month and a half. We're fast, but your records are insane.
Well, speed is critical, and you're going to have different speeds from different lenders depending on, there's the old guy that just lends out his money to a few people he knows, and then there's the well-funded national hard money, and everything in between. So speed varies. We have closed loans in as little as 2 days. But that is for people that we've done a lot of deals with.
History.
Yeah. Normally we close in a couple weeks. If we have 3, we're very comfortable and everybody's relaxed and nobody's rushing. But 2 weeks is kind of norm. We're out to the property in a couple days after you send us the application. And then we decide right then when, if we're going to do the deal or not. We negotiate the terms with you and then issue the term sheet the next day, send it to our attorney, move to close, end of story.
End of story.
So then it's just waiting for title to come back. So speed is one factor, and the most important, in my opinion, is credibility, because I've heard so many horror stories of people that they'll call a national lender, and the property's in New Hampshire, and 2 days before close, the guy says, "Oh, sorry, we don't lend in New Hampshire."
Yeah, it's a disaster.
Amazing, right? So like they didn't know that.
Right.
The other thing is that you have to know that someone is going to deliver what they say what they do and do what they say. And with private lenders, you don't have any idea of that until you actually work with them. So I always tell people, ask around about me, get references, go to a real estate investor meeting, talk to people about who they use, ask about me. What do they have to say about me? They're never going to say, "Oh, she's the sweetest little lady." That's not what they're going to say.
I love it.
But they're
You do
always,
have a baseball bat.
I know I don't. But I'm very direct, and I always deliver what I say. I don't sugarcoat stuff. So people know exactly where their deal stands.
I love it.
So that's very important. But that's the case in your business. I'm not going to presume about your business.
Sure. What are the typical terms? I don't know if I asked that earlier, and I think that's kind of key. Are these 90 days or 180 days? You won't do anything more than a certain period, or their exit strategy needs to be in X amount of months?
So our term is 12 months.
12 months. Okay, way longer than I expected.
We expect people to be out of the loan earlier.
Okay.
But it used to be that hard money lenders would say, "Okay, I'll give you a 3-month loan," and then it's negotiating time.
Right.
Meaning, I'm going to pile on the fees.
You're handcuffed.
Right, I'm going to pile on the fees. So we don't do that.
Okay.
So we used to have 6-month terms, and then it started to take longer to do a flip because it just life changed everything. So our terms are just 12 months now. So you don't keep it for the whole 12 months. You don't pay for the whole 12 months. We do have a minimum of 3 months interest.
Okay.
But if you turn around and sell your project in 30 days, that's fine. We just want our 3 months interest and then we're done.
And then you're out.
But you don't have any pressure till those 12 months.
I love it.
We don't foreclose on technicalities if you're 12 months and 2 weeks because your buyer, you had to find a new buyer or, whatever. Or your refinancing fell through and you had to go find another lender. So 12-month terms. I think the percentage down we talked about.
Yeah.
There are interest-only payments. What did I miss there? Oh, rates.
Yeah.
You probably want to know rates.
Yeah. Can you talk about rates?
I can. They vary mostly based on experience.
Okay.
So rates are from 10 to 12%.
Okay.
They're interest-only payments. You also pay points, which are between 1.5 and 2 points.
Okay.
Those are capitalized into the loan, so you don't pay them at close.
I love it. So part of the payoff.
Yeah, it's part of the payoff, exactly. And we're all transparent about that. That's all in the term sheet, and you know exactly what you're paying.
I'll be honest with you, the cost, I really didn't know. It's better than I expected.
Is it?
It is. And
People hearing this for the first time, though, are under the table. They're falling on the floor at the thought of 12%
okay,
interest.
let me put it from this perspective. You're not pulling credit. You're doing your
No.
own appraisal. It's a 4-page, what's your email and phone number.
Right. And we have no idea if you have any income to cover these payments either.
I can't even go to my dad and get those terms. Okay.
It's true.
So ask your dad if he's going to give you the money. Ask your mom if they're going to give you money. I think those are incredible terms, and a year payback is amazing. So, Ann, I can't even begin to tell you. I have to have you back again. This information is so valuable for our listeners out there. This is Ann Bellamy. It's buynowhardmoney.com. Here's her phone numbers that are up here. We'll also list it in there. But this is exactly what I needed to know a little bit. It is way easier than I thought. The interest rate and the terms, I think, are way better. Interest-only payments are great. No appraisal, no credit is unheard of. Okay, it truly is. So
It's my everyday.
I know. It's incredible.
Yeah,
So
that's why people are afraid of it. They just don't know.
they don't know. And
But if they call me, we'll talk about it.
We'll talk about
Call me
it.
anytime.
And you make quick decisions. This is going to work
We
or it's
do.
not.
Yes, I seldom waffle. Yeah.
And before I let you go, if it's something that doesn't fit in the box for you, does that mean that you might have someone that says, hey, if you reach out to this person, they might? Do you do referrals like that, or?
I do referrals all the time to conventional.
Okay.
Okay, because I just want to emphasize this. If people qualify for conventional, whether conventional residential or conventional commercial, you should use it. You shouldn't use hard money.
Sure.
Unless you don't have time for those.
Right.
There is no reason to pay more when your deal and your own personal credit qualifies. Having said that, I do not refer to other hard money lenders except in one specific case.
Okay.
If people call me for a loan in Massachusetts for a primary residence for hard money, I do know one person that does
Okay.
them. I don't do them at all. I don't touch them. And I don't even recommend him because I've never done business with him. I just know he exists.
Okay.
So I send him those deals. That's it. But other than that, I refer to residential lenders and I refer to commercial lenders.
Okay.
That's it. But not other hard money because I have to be able to recommend somebody if I'm going to refer them.
Sure.
And I can't always do that.
Gotcha. Well, Ann, this segment, I've been so excited for this. So
Good.
I really appreciate you coming in today.
It was my pleasure. It was fun.
Yeah, it was. It was easy. It was fun. We're going to build on this because I know I'm going to have more questions after this. So we'll have you back. But thanks for coming in
Happy
today.
to do it.
Thank you so much.
You're very welcome. Thank you.